Futures Radio Show, sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com.
Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
Hey everybody, thanks for tuning in for this episode with Yra Harris. Remember, new shows are posted every Monday and Thursday. You can subscribe to the show on iTunes and YouTube. If you're enjoying the show, please leave a review on iTunes. Before I play today's interview for you, I want to give a shout out to the great sponsors of Futures Radio Show: CME Group, Trading Technologies, RJO Futures, and Top Step Trader. To learn more about these sponsors and the important things they are doing for futures traders, be sure to click on their logos on our website. Today I spoke with Yra Harris. He's an independent trader and writer of one of my favorite blogs, Notes from Underground. Today Ira shares with us what he's seeing in U.S. equities. We talked about yield curves. Ira explains to us why oil traders should be keeping an eye on Russia. We talked about China and tariffs. Finally, we discussed gold versus global currencies, and Ira tells us what markets he is watching for possible trade opportunities. Without further ado, let me take you right to the interview with Ira. Ira, thanks for joining me.
Oh, Anthony, this is it's a highlight of my day here in rainy Scottsdale.
Well, it's good to see that you're in Scottsdale and you're out of Chicago. It gets 30 degrees there.
Oh yeah, I know. You know what? And I don't talk just like you're in Florida. I don't. All my friends and family, which I have so many in Chicago, I never talk weather because, it's just not the way I operate. It's why add to your misery because the weather can be so freaking miserable.
Well, see, I like to rub it in everybody back home. So everybody, I will be playing golf this weekend. But Ira, let's talk about markets. And as the media likes to say, when the markets go down, markets are in turmoil, which I think is pretty ridiculous in my opinion, because I actually think when markets get this volatile and they sell off, they're telling us what's really happening. I think and they're actually functioning properly. So right now, what are you seeing in equity markets?
Well, the equity markets are a function of several things around the world, and they're finally reacting to the I like to call them possible prairie fires because it takes a spark to start a prairie fire. There's a lot of major uncertainty, and it's been out there. But when interest rates were so low and there was so much liquidity, it was able to overcome it. I just think the markets right now are repricing themselves to a genuine risk factor now that so much liquidity is being withdrawn by the central banks. The United States, of course, is leading the way. The Japanese haven't started. In fact, they're still adding. The ECB, the European Central Bank, at the end of this month, although there's a meeting next week, so I doubt they're going to change, but they're going to stop adding more liquidity. They'll just keep repurchasing stuff when it comes due, but there will be no additional. So you're having a decline in the amount, but of course the Fed is shrinking its balance sheet, so it's taking out reserves of $50 billion a month from the $4.5 trillion that it added, and that with raising rates, I think, is having an impact to at least see a genuine repricing of risk in the marketplace. That's what I think is going on.
Are there specific days throughout the month that the Fed is shrinking the balance sheet to where you can see that they're shrinking the balance sheet and then the market is reacting off of that?
No, it's an ongoing process, but it's just the culmination of, at the end of a month, they've shrunk the balance sheet by $50 billion. There are certain people who know when the desk, I don't have that type of access. I've always kind of marveled at that there's the what's called the TBAC, the Treasury Borrowing Advisory Committee, who advises the Treasury on how they should do the debt. How many T-bills, how many 2-year notes. They give them a sense. It's not that they necessarily follow them, but even Steve Mnuchin the other day was railing against the leaks out of TBAC, because these are market players who are involved on that committee, which I've always has never sat well with me, so to speak. Why should these people? To me, if you're there at the table, you have an inherent advantage to knowing. You may not know exactly, but you know what the mindset is. Well, if I know what the mindset is of policymakers, it's a pretty good advantage. I feel the same way about the G30, which most people don't even know about, but that's a group I've also kind of questioned why they should have that type of access. But that's another show.
Yeah. There's a lot of headlines right now about yield curves, and you and I, we've been talking about yield curves for many years, but just the past couple of years in the show, you and I have been talking a lot about yield curves, and I actually credit you to getting me to watch specifically the 210 and the 530. And a lot of the news right now about yield curves is the inverted yield curve, the 3.5, which personally I don't really think that matters. I've never even watched the 3.5. I don't know. We'll see what you think. But also, when the curves that you and I look at, primarily the 210, which is sitting right around 13, and then the 530, which has been right now between 38 and 40, those have diverged. So you have an inverted 3.5, you have a 210 that's sitting really low, but it's not yet inverted. I say not yet, it may never, but it's flat, pretty flat. And then you have the 530, which is, like I said, diverged from the 210, which is sitting around 38 and 40. What do you think about all these yield curves right now?
Well, I'm a big believer in them. So I think, and as I wrote last week on the blog, it was kind of preposterous to me that these curves were flattening, especially after the G20 meeting, when commodities rallied, the dollar went lower, the Chinese yuan had gained strength, the metals were higher, and yet the curve was flattening. So the 210 was dramatically. The 530 actually followed it, but the 210 led the way. And it made me wonder, because everybody's looking for reasons. And to me, it's preposterous that this curve is flattening now. And it's not that, everybody's out there, all the experts, people who, when you and I would talk about it, when Rick Santelli and I, been talking about this for 3 years. And as you know, when the 210 broke through that big level, which I had at 74 basis points, when it was positively steep, I said that's going to be a danger sign. But the 530, of course, had already broken all the support levels and was headed towards flattening far earlier than the 210. But they usually send a message about tightening, that the central banks may be too tight, that the economies are slowing, or that there's something wrong. Something is wrong somewhere. Now, everybody's looking for this. And I'm not sure that this time, and again, we don't know, because what the central banks have essentially done with their QE is broken the signaling mechanism of market pricing. We've also talked about that, and that's been a major negative fallout from all the central bank intervention. The signaling mechanisms are different. So will this one be different? Hard to say. But I think that the 210 has been flattening. When I step back and take a look at it, especially when we saw Monday's dramatic flattening, on top of the supposed successful G20, it made me think that the impact from what the Fed is doing by shrinking its balance sheet while talking, quote unquote, hawkish and raising short-term interest rates, that the impact was far greater than most people realize. In fact, the person who's in charge of this, it's like, I know you had asked me a question about, well, can you see when they're shrinking the balance sheet every month? Because it's $50 billion a month. And I said, no, I don't have that type of access. But the one Simon Potter is his name, who runs what's called the SOMA, which is the Security Open Market Account, which does the transactions for the Fed. And it's a very powerful position. Before Simon Potter was a guy named Brian Sack. I loved reading his speeches. I thought he was one of the great people working at the Fed. I'm not a Simon Potter fan, even though, like me, he went to graduate school at the University of Wisconsin, so I should hold him in higher esteem. But I'm going to leave that alone because he says that this is not having that great of impact. I disagree because I think the markets are telling you that the combination of raising rates while shrinking the balance sheet is having a far more dramatic impact than the Fed wants to believe. Why? Because it flies in the face of they don't really have an exit strategy. Because if this is the impact from what they're doing, no, they're going to have to go back and rethink how they should do this. And if that's the case, well, then the Fed should stop raising short-term interest rates and just start shrinking the balance sheet, because that's evidently enough to rein in the excess liquidity in the system that worries them. So they're going to have to make a decision. This is what I'm watching. And I think in the short term here, this is what the 210 is telling you. But, and I don't mean to be a two-fisted economist, because I'm not, because I trade for a living and I just analyze markets to give me a perspective. That's how I develop my perspective and how I develop my trades, outside of course using technicals for my risk profile. But here's why I tell people, if you buy more than a 5-year treasury today, if you're an investor, you're out of your mind. And that's why I'm not buying into, I'm actually putting steepeners on. I put a steepener on. I had to test the water when it got down to 10 on Tuesday. I did put some on. I took them off this morning because we have unemployment tomorrow, and I'm hoping I get another opportunity at it. But I don't think this curve is going to invert unless there's somebody out there who's stuck so badly, which could be. But I don't think it's going to invert, because you have to be nuts as an investor to buy long-term U.S. debt. And here's my reason for that. Is that the last time we were down to these unemployment levels, when Bill Clinton was president, we were running budget surpluses. The conversation, Anthony, when you were standing in the S&P pit was, wow, these budget surpluses are so big that pretty soon we're going to run out of, there's going to be no bond market because we're not going to have to do any borrowing. Remember that in the Greenspan years? Well, that was true. You can go back and find all the quotes you want. In fact, the congressional CBO had talked about it. Oh, we're going to have surpluses as far as the eye could see. Well, right now we're back down to those unemployment levels at 3.7%, and we're running over $1 trillion deficit this year. So this flies in the face of everything that, if you're a Keynesian, you believe, because Keynes said that when the economy is so robust, you're supposed to run budget surpluses, not deficits. And you're supposed to basically save for a rainy day. That's what the government, so the government would, if the economy started slowing down, they would ramp up government spending in order to boost demand, which would lessen the impact of a recession. We are totally broken. We're at 3.7%. The economy is supposed to be so good, and we are running a deficit of over $1 trillion. If you want to buy long-term debt into that scenario, God bless you. But if you were managing my money, I would have been out. You would have closed my account yesterday.
I couldn't agree with you more. So what happens if unemployment starts to tick up? Then I wonder, what is the impact that's going to have on this country?
Oh, you know what? It gets dangerous. And this is not conspiratorial. I'm not a black. I'm just looking at the reality of the numbers.
Yeah.
And the numbers are saying, look at this time it's different, which tells me, and this is what the stock market, going back to that, is reacting to, is that, hey, when debt builds up, which is what we've seen for the last 10 years, all you're doing in economic terms is bringing demand forward. That's all you're doing. When you have a credit card and you go out and buy things on credit and you have installment debt that you pay off over, all you're doing is bringing your demand forward. So if that's what we've done, is, Greenspan, and I don't agree with Alan Greenspan on a lot of things. But it's not to say he's not a smart man. He is a smart man. We just disagree on things. But when he took the Trump administration to task for that tax, not that corporate taxes should have been cut, they absolutely should have, but it should have been a neutral basis and they should have found ways to raise them to pay for it. But when he said it was so wrong to do this because of the unemployment levels at that time, that they were making a mistake, well, we may well be seeing that. And if you believe that, then why would you buy long-term debt? I know this is not easy, and to understand, but just step back and look at the numbers and say, how can this possibly be? What am I missing here? And if you stay in that regard, well, we are really hanging on a dangerous time. In fact, Donald Trump yesterday, after the Herbert Walker's funeral, Herbert Walker Bush, and then he was back tweeting, and he tweeted out, in talking about this debt situation, he said, well, I won't be in office or I won't be around when it implodes, which we've heard from other people. He's not the first sitting politician to say a comment like that, because they always live for that. But my statement is, I just wouldn't be buying long-term U.S. debt. I can buy a 2-year Treasury note. Here, I got the numbers in front of me. The 2-year this morning was 276. The 10-year is 288. So for 13 basis points, you want me to take 8 more years of duration risk with an exploding deficit? You're out of your mind. Yeah. And I'm telling you, if you have a portfolio manager managing your money and they're buying you 10-year debt, run as fast as you can. I'm the gingerbread man. You know what? I'm sorry. It's ludicrous. So we're seeing this flattening, and it's amazing because who is buying this debt? That's the and it's not a conundrum. I just want to know who's in trouble enough that they're running to that, and it's a gigantic error. It may not be an error because one of the people who I engaged with on the blog and through tweeting, he said, well, you said I'm an idiot, but I've been long TLT. I said, step back. I applaud your trade. If you've been long 10-year notes, because technically you're supposed to be long 10 right now. You're not supposed to be short. I applaud it, but don't treat it as more than a trade. Don't turn it into an investment because you will pay a steep price. That's my only point. And when I talk about it, Anthony, we always break the world up between traders and investors because they're not the same. They may find common ground, for a period of time, but an investor's horizon, like a Warren Buffett, is far different than the people that we interact with and who I think your great podcasts play to, which is traders.
Yeah.
That's a whole different, to me, if I'm going to trade for 3 weeks, that's a long duration trade.
Yeah, I mean, I've talked about this so much, and on Twitter the other day, I've said, as a trader, I can be right and lose money and be wrong and make money.
Right.
So let's talk. A couple things I want to go back to yield curves about. Yep. So everyone's talking about the 3-5 being inverted. Just quickly, does it matter or no? Not
to me. You know what?
Okay.
It may matter to some, and they'll roll out some, mathematical model that says that it's important. Now, a lot of people, and Peter Bookvar and Jimmy Bianco, who I have a lot of respect for, they pay more attention to the 3-month, 10-year, because that's as pure as you can get. Okay. The reason that we've all, and you and I have talked about this many times on your podcast, the 2-10, because they're both securities. The 3-month is not a security. You have no capital gain in there. It's all short term. So that's why, it's different. And the 530, let's go back to it really quick, because it's holding above the 200-day moving average in a steepening condition, I'm really paying attention to that, because as it led the flattening down, it has turned up here and has sustained the up far more than the 210, which I'm finding fascinating. And it's really directing me to put on the 210 steepeners. I could be wrong here. I'm not going to be wrong for a lot of money, I'll tell you that. My risk parameters are very narrow on this.
Yeah, that's why earlier I said they diverge, because the 200-day and the 530 is roughly 32 in change, and they're trading above that, while the 210 is well below its 200-day. And like you said, on the way down, the 530 led on the flattening side, and maybe now leads on the steepening side. But I want to move on and talk about Russia. Not because I want to talk about Russia, it's because I read your blog, and two of posts in a row, you were talking about Russia. So I said, you know what, I need to ask Ira why you think, and you said this, the Russia situation needs to be closely watched.
Yes, I believe that. I'll tell you what. Look, I had the great pleasure of sitting with you. We did a live streaming pod on October 5th, I believe, 2017, with Mr. Santelli. And at the end of we took a lot of questions, and you posed a question: were you bullish or bearish crude oil? And you had taken a little bit of poll of the audience, and they were heavily bearish the oil. And I sat there, and people can go back and listen to it. And I said, I see the fundamentals of the supply demand, and you should be bearish. But I said something to you, because it was that day history was made, because the Saudi king, not the crown prince, MBS, the Saudi king went to Moscow, October 5th, 2017. The low of crude that day or two was $49.50 on WTI. And then from that day on, and I said, pay attention, because this is a highly unusual event. The Saudi king going to Moscow, unheard of. These are the major heathens of the pagans of the world. He's going, and then oil went straight up to $75. Grind higher, but it traded up to $75 before its recent collapse. The low last week, I think, was $49.35. So I'm watching Russia very carefully here, because it's intriguing me, because as Trump, Putin wants these sanctions off. He wants them off. He wants to stop being the bad poster child. He wants to stop being under the thumb of the United States for everything that it does. So, and Trump keeps pushing for lower oil. Well, I keep talking about Russia, because after the G20, and I said, watch Putin and MBS at the G20, because the Russians and Saudis, they have a lot to gain here. And the Saudis, as much as they owe the United States for all the things the United States have done to protect them in the area for 80 years, the Russians have recently bailed out the Saudis in Syria. They're keeping Iran under its thumb, so to speak. Not people would deny that, but the Russians have with what they did in Syria, they have a lot of strength to play in the Mideast. They've got with Erdogan, so Putin has a lot of potential strength in this whole game. So I want to see if the Saudis and Russians come out with some kind of bigger cut in oil to drive oil prices higher. That's why I'm talking about it. Right now, we're trading. I'm looking at January crude. We're trading 50.82. It's down $2 on the day, but we're down back into these levels. I want to see if these levels are important, and if they cut enough oil out to send prices higher, especially as we're into the winter months. You want to send a message to the world? See how cold it gets in Western Europe. And Western Europe is so dependent upon Russian energy. So, and as Trump, makes Putin's life miserable openly, I don't know what's going on behind the scenes, but The Russians have cards to play, and they have them to play with the Saudis. That's my point.
Hey everyone, I hope you're enjoying the show so far, but I want to pause and thank one of our sponsors, Trading Technologies. I started using TT in the year 2000, and I love it. It is by far the best trading platform I have ever used, and I've tried a lot of them. With TT, you can trade the global markets from virtually anywhere in the world. They are the world's fastest commercially available futures trading platform. I highly suggest you go try out TT, especially because you can try it for free. Just go to tryttnow.com and set up your account. Let's move on and talk about the tariffs and China. I know that there are so many experts on China now out there. I'm definitely not one of them. But like I said, I always go to your blog to see what you think about what's going on in a macro sense. So what do you think about tariffs in China?
Yeah, you have to pay attention to it. I think it's overblown at this point in time because the Chinese, I think, are, as I've blogged about, are cautious here. It's not that, as much as the world despises Trump, they didn't despise him as much as this recent G20 meeting in Buenos Aires. And right before the meeting, it was interesting. Germany and the UK, Britain, put out a thing that they were going to be very careful about allowing Chinese telecoms like Huawei to partake in the rollout of 5G because they were really worried about cyber espionage. So the Chinese, if Xi had been successful in uniting and unifying everybody against Trump, he could have played a stronger hand, but they're not. And Trump has actually worked on raising the world's criticism of the Chinese. So I think the Chinese are going to, and they did at the G20, they took a step back, which is classic Mao thinking, 2 steps forward, 1 step back. Because if your hand isn't that strong, step back. And they did, and they offered certain things. Now, of course, it'll be a slow dance out, but that's okay. We're going to start to see certain things develop, which will be interesting. So I don't think we'll see the 25% tariffs. I don't. And, one of my keys to watch, of course, is the Chinese yuan, which did strengthen quite a bit on the first 2 days after the G20. Now it's weaker today on the news about the arrest of the CEO and chairman of Huawei's daughter in Canada and supposed extradition to the U.S. And that's what really hit the stock markets from the get-go last night because, again, it called into question everything that was supposedly agreed to at the G20. I'll watch here, but I think the tariff situation will calm down a little bit. Now, it may heat up in Europe if Trump gets irritated enough with the Europeans, because the German car makers were in Washington talking with Lighthizer and Navarro on Tuesday, because Trump likes to poke at the Europeans, especially the way he was abused by Merkel and Macron back at the G7 meeting, and how they like to stick at him. But there's a lot going on here, and if you look at the European stock markets, especially the DAX has been so weak. Look at it, it's down almost 3% today. It's been very weak this year. It's down 15, 16%, and in dollar terms, it's down over 20%. Be careful here. Those could get some because Trump is running around and he's good at pointing at distracting from what don't look here, look there. So he's good at. So he may raise that issue, but very cautious. That's the way. But I'm not. I think the tariff issue will calm down here a little bit because everybody wants it to calm down, and there's too many other things. The things we talked about. There's Russia. We're not even talking about what could potentially go bad in the Mideast. We have politics in Mexico and Brazil, which are gotten interesting, and of course the rise of the populist right in Europe across the board. And the issue that I've discussed, I know farther than most, and is Italy and the impact, and that's not done yet. So, and the Italians have a very strong hand to play here, and we're still dealing with Brexit. So you've got a lot of things up in the air. And as we talked before, I said, if you've been short volatility, I said this all year, I said it last year. Okay, I know you're picking up nickels and dimes in front of that proverbial steamroller, but you better pay attention here, because there are many, many things on the boil here that are very dangerous. And that's with Trump getting ready for the 2020 election, or maybe not. So we got a lot of things on the plate.
From your perspective as a trader, what are the top things that you're looking at for trade opportunities right now? What's at the top of your radar?
I've got the yield curve. I'm loving the gold, and I'm not a gold bug per se. I'm just watching the market. And when I buy it, I sell it. But I've been watching the gold against the world's currencies, and we've seen some very nice action. Gold euro, gold Swiss, gold yen is kind of hanging in there because the yen gets a little bit of a safe haven bid. Gold yuan is one of the most interesting, because the Chinese government has been the biggest buyer of gold. We can discuss why, that's a whole nother show as to what their ultimate end may be. But these are going on. So I'm watching that, and I'm watching these yield curves, because again, I'm stating that I don't think they're going to invert. If they do invert, I'm not going to make in 2006, I made a big deal about it, and it was a very good catch because a lot of people weren't paying attention to it. But I've watched the yield curves for 35, 40 years. I've had interns write great papers for me about it. So I've watched these yield curves because I think they move the markets quite a bit. But I'm going to throw out a question to you. If I ask you who has the flattest yield curve in the world right now, of the major countries that matter?
Oh, I don't watch the other ones, so I wouldn't know.
Canada. This week, the Bank of Canada met this week. They didn't do anything with rates, but the 210 in Canada was down to 4 basis points. Now, they never did a QE program, so it's interesting to see what in fact took place with the Canadians. I've kind of enjoyed watching it. It's another one of those harbinger. Is it a harbinger or not? We'll watch it, but it's interesting, to say the least.
Yeah, to say the least. So a couple things. I want to go back to the things that were on the top of your radar. So the yield curve, the question I have for you about this is, you mentioned how the 530, it was over the 200-day moving average, and it's leading the steepeners. It's steepening, so that could potentially pull the 210 up, just like on the reverse. When it got below the 200-day, the 530 did first. It pulled it down. So for me, Ira, a lot of times what I like to do when I'm comparing markets using correlations, I like to buy the stronger one because it's the one that's acting better. And in this situation, you're buying their weaker one and hoping that catches up. So I guess I'm just wondering in your mind why you're going about it that way.
Guilty as charged. You know what? I'm a little conservative here right now because I have to. So if the 530 were to blow, and it's so definable, but I can define this whole trade now by that 200-day on the 530.
Gotcha. So what you're saying is you're going to be
right.
long the 210 using the 530 200-day as your tipping point to cover the long of the 210.
Exactly. Believe me, this is not a big trade. I'm testing the waters. I had it on. I had a nice day trading it from Tuesday and I bought the two-year outright last night because I saw what was going on in the stock market. And there are ratios that you're supposed to use. Bloomberg, of course, puts them out. I don't know where else because I always get them from someone. I don't have a Bloomberg directly, but I have. I know so many people have them, so I'll just call them and ask them what the ratio is. So right now the 210 is about. You're supposed to be long 2 years for every 10-year, and that's based really more on volatility than anything. The way historic measures of volatility. but it's what I'm watching. And the equity markets this sell-off is serious, not life-threatening to it. And again, it's really, I think, most important that it's a repricing of risk overall, which is healthy. The market, as you opened up the show, Anthony, the market needs that healthiness. The frothiness that was created by these QE, negative interest rates, zero interest rates, has not been healthy for investors. A lot of people have taken on a far more risk than they're comfortable with, and they'll realize it when they get their monthly statements. They have far, because why? They were busy chasing return.
Absolutely.
Right?
Yep.
Yeah, that's what they were doing. And so Ben Bernanke pushed you into it. He called it. He had a name for it, portfolio balance channel, in which you would reorientate your portfolio to take on more risk. Jackson Hole, 2010. That was the speech. He put an article in the Washington Post. He had op-ed pieces. That's what it was, and that's what we did. And I think people have overstayed their welcome about how much risk that they've taken on. That's just my view of it. They all want to celebrate the great stuff that they did, but I've been very critical of the Fed and Bernanke. I have, and Janet Yellen. I thought that they stayed way too long. As I said, I would have driven Fed funds rates to 3% quickly, or else I would have started shrinking that balance sheet way sooner. But one or the other, they waited way too long. And the biggest mistake that was made was May and June of 2013 during the so-called taper tantrum, when the Fed announced it was going to start shrinking its balance sheet, and the market reacted so violently that Bernanke backed off. It was a gigantic mistake.
Last thing before I let you go, Ira, I want to stay on the trade opportunities. When you talked about gold versus all these different currencies, what are you looking at specifically that would trigger a possible trade? I know that you look at both technicals and fundamentals when it comes to your trading decisions. So how are you deciding which currency you'll be trading gold against?
I'll look at the technicals, or I like to trade the gold against the Swiss because there's such a nice correlation historically between them. But it's been more difficult because the Swiss goes back and forth. Like tomorrow, they're having a big meeting in Switzerland, the 7 cantons, about what to do with the EU, because Brussels is putting a lot of pressure on Switzerland to become more involved in the EU as far as laws, and so that has issues. But Switzerland has negative interest rates, and they've been printing money. I've been on the Swiss bank has made a major mistake here. When it blows up, I don't know. But this concept of printing, they've gotten away with it because everybody wants to own Swiss francs, meaning they use it as a depository for almost a safe haven, as a safe haven. So I like that one. I like to watch. Japan has some interesting issues, but Japan's also a haven because people go running there during times of uncertainty. And Japanese investors bring money home during times of uncertainty. So you see the yen go up during volatile times. A lot of people like the gold euro. I think that's probably the best one, the purest one, because the European Union has issues. And let me tell you why I like, people say gold's a hedge against inflation. I've tried to explain to people for 25 years that that's a wrong way to look at it. Gold is a hedge against central banks losing control. Because right now everybody thinks that they have everything under control, the QE. And what we'll see and what will really make gold and silver ratchet up is if all of a sudden the Fed were to do an about face. I'm not talking about stop raising rates. That'll help gold, and I think that's why we're seeing gold go up a little bit over the last couple of weeks anyway. But if the Fed actually had to announce some type of new program and said, well, we're going to stop shrinking the balance sheet for a while, we think things are, gold would get a bid. And that's what I'm watching, because that's what gold is truly pegged against, because gold is the ultimate currency. Gold is the ultimate currency. And if you don't think that the Chinese and the Russians are searching for a way to create a gold-backed currency, you're not paying attention. Because the more the U.S. applies sanctions, and the sanctions are only viable that the U.S. puts on because of the role of the dollar as a reserve currency and the ability that you have to electronically transfer it to what is known as the SWIFT system. So that allows the reach of the U.S. all over the world. The Chinese don't like it. They don't like being threatened with sanctions. The Russians, as I said before with Putin, why you have to watch them, they don't like being because who's the U.S. in their mind? Who's the U.S. and you're controlling the system? So that's what I'm paying attention to. I think it's very important. And that's what we have to do. So that's what I'm looking for. I watch them all, Anthony, because they all tell a different story. Here, classic. The gold Swiss just broke above the 200-day moving average. Okay, as long as we're walking down the side. But it's been well above the 200 week. You can put up the charts for quite a while. The gold euro has been totally opposite. It's been above the 200-day. Here, let me put it up but it's just starting to creep above the 200 week. So they've been totally different, and I find we're just hitting right now the 200 week moving average. So it gives me a longer perspective. On the gold euro, the 200 week moving average is 1,078. That's 1,078 euros to an ounce of gold. So this month we're finally breaking above there, and right now it's 1088. I'm up to date as the week of December 3rd, and right now we're trading 1089, 1,089. So we're right here, but they're two currencies against gold, two different pictures on a longer term basis. I find that interesting, but I'm getting the gold euro right now at the 200 week moving average. Tomorrow's Friday, unemployment day. We'll get a better look. We'll take a good look at this tomorrow. If it closes above there, I'm going to go gold euro, even though it's been on a sizable run here. I should really like to see it set back a little bit, but I don't know if I'm going to get that opportunity.
Great stuff as usual, Ira. Thank you so much for sharing all of this with us today. Where can people find you on Twitter? And of course, tell us where people can go and read your blog.
You go to Notes from Underground is the blog. And I think that's how, and you find Ira Harris, hashtag Ira Harris, I think, Twitter. And I've actually started to, I'm not a big Twitter fan. I've been a fan of the stock, which has done well for me, but not a big fan of using it because I felt I could never be condensed into that small. As you can see, it's not that I write verbosely, but I got things to say and I didn't want to be pigeonholed down to that. And I didn't like a lot of the people who seem to be playing in the arena. But now more people, I put the blog out on Twitter, so it gets read there. And that gets me a lot more interaction, and I like the interaction. And the blog is, Anthony, it's not just what I write. I mean, the blog I wrote Monday night was really, there's 15 comments on there, one better than the next. They're really very astute, and they're not, again, as you know, Anthony, I don't need anybody to validate me. I don't need validation. I want discourse because I can learn from everybody else, with everybody with ideas who may be saying, well, I think you're crazy with that. And that's fine. Tell me why you think I'm crazy. And I'm really, it's like when I made the comment about you're nuts to buy the long end. And the guy says, well, I've been long TLT and I'm doing well. I said, I applaud the trade, but he took me to task for it. And that's good. That's the way we learn. That's the way we grow. And the more you grow, the more money you're going to make in this business.
Great stuff as usual, Ira. Thank you so much for coming on Futures Radio Show.
Anthony, enjoy Naples, my friend.
I absolutely will. Thanks, buddy.
Okay, be well.
Thank you for listening to Futures Radio Show. If you have any questions or comments for myself or my guests, please visit futuresradioshow.com and sign up to be a premium member for free. If you enjoyed the show, don't forget to leave us a review on iTunes.